In this video, you will learn how the market actually behaves across different conditions and how to adapt your strategy to each one using price action, market structure, and a liquidity trading strategy. We will break down how trends form, how reversals happen, and how price moves between key levels so you can clearly understand how professional traders trade using concepts like support and resistance, order blocks, and supply and demand liquidity. By the end, you will understand how to apply a complete market structure trading strategy in trending, ranging, and choppy markets, instead of using the same approach everywhere. Whether you are refining a scalping trading strategy in forex or building a trading strategy that works every day, this will help you read the market with more clarity and execute with confidence, just like professional traders. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. To begin, let's focus on a trending market. A trending market is defined by price consistently moving in one direction over time. In an uptrend, the market creates higher highs and higher lows, while respecting previous swing lows. Respecting a previous swing low means that price continues pushing upward without breaking below that level. After each breakout, the lowest point of the pullback becomes the new reference swing low, reinforcing structure. With that in mind, our directional bias becomes bullish, and we focus only on buying opportunities as long as price remains above this key level. But what happens if price breaks and closes below the swing low? This indicates that buyers are starting to lose control and the market may no longer be in a valid uptrend. In contrast, a downtrend works in the opposite way, with price forming lower lows and lower highs while respecting swing highs. In this case, we define the environment as bearish and look for selling opportunities as long as price stays below the previous swing high. When price breaks above a previous high in an uptrend with a strong close, we mark it as a break of structure, also known as BOS. This signals continuation and confirms that buyers are still in control of the market. Because of that, we continue looking for buying opportunities. We then mark the beginning of that breakout move as the new swing low and define our trading range. From there, we expect price to retrace, find rejection within that range, and continue higher, ideally reaching or exceeding the previous high. But if price fails to continue higher and instead closes below the swing low, the context changes. At this point, we identify a change of character. This signals a potential reversal and suggests that buyers are losing control of the market. After this shift, we begin to anticipate a possible change in direction and start looking for selling opportunities with more caution and confirmation. Another key signal of reversal is a shift in momentum. In this example, we initially see a strong bullish breakout with large candles indicating strong buying pressure. However, if price suddenly reverses and forms large bearish candles, it signals that sellers are stepping in aggressively and momentum is shifting in the opposite direction. This sudden change in momentum shows that buyers are losing control while sellers gain strength, which can lead to a potential reversal in market direction. A trending market is often the cleanest and most profitable environment to trade, but not all trends behave the same way. Understanding the difference between ideal and imperfect trends is essential. An ideal trend is smooth, clean, and clearly respects structure. Pullbacks are controlled, and price reacts precisely at key levels, making execution more predictable. On the other hand, an imperfect trend is more irregular, with deeper pullbacks, false signals, and choppy structure that can easily create confusion if not properly understood. To avoid being trapped in imperfect trends, it is crucial to recognize common market traps, especially invalid changes of character. The first one is failure to continue. If price breaks below a swing low, but fails to move lower and quickly reverses upward, that change of character becomes weak or invalid, particularly if price then breaks above the previous high again. This behavior confirms that the market remains bullish despite the temporary breakdown. The second trap is a liquidity hunt. If the swing low sits in a liquidity zone, price may briefly break below it to trigger stop losses and then reverse. This move is not a true reversal, but rather a liquidity grab, making the change of character invalid. The third trap involves fair value gap mitigation. If a fair value gap exists below the swing low, price may drop to fill or mitigate that imbalance before continuing higher. In this case, the downward move is only a reaction, not a structural shift, which again invalidates the change of character. Now that this foundation is clear, we can move into some of the most effective trading strategies for trending markets and see how a liquidity trading strategy aligns with both continuation and reversal setups. These strategies can be divided into two main categories: trend continuation setups and reversal setups. The first and most common approach is buying the pullback after a break of structure. Instead of chasing price, we wait patiently for a pullback to enter at a more favorable level. We define our range from the swing low to the new high and wait for price to retrace into that zone. The ideal scenario is to see rejection around the 0.618 Fibonacci level, or within a fair value gap, before entering the trade and targeting at least the previous high. This approach is considered one of the safest and most consistent ways to trade within a trend, because it allows you to enter with confirmation instead of chasing price. Now, building on that logic, the next strategy to understand is the break and retest. In a bullish trend, we wait for price to form a double top rejection pattern. Once price breaks above that key level, we wait for it to return and retest the same area. If the level holds and price shows rejection, such as a long wick candlestick, we enter the trade and place the stop loss below the zone. In a bearish trend, the logic is mirrored. We wait for a double bottom rejection pattern, and if price breaks below that level, we wait for a retest. If the level holds and price shows rejection, such as an engulfing candlestick, we enter the trade and place the stop loss above the zone, maintaining proper risk control and structure. Now that these continuation strategies are clear, we can move forward and start exploring reversal strategies in more depth, building on everything you have just learned. Number 3 focuses on the change of character entry. After a long-term bullish trend, we wait for price to form a clear change of character. To confirm a valid reversal, we need at least 1 or 2 strong bearish moves that break below the previous swing low. After that, we look for fair value gaps that form following the CHOCH and set a sell limit at the beginning of that gap, aligning with the new bearish context. Next, we place the stop loss above the setup and target the next significant level below the current price. Moving on to number 4, we have inversion, fair value gap, and liquidity. A high probability setup appears when price sweeps liquidity above previous highs and then forms an inversion fair value gap. This clearly indicates a shift in momentum after an extended uptrend, where the market takes buy-side liquidity and begins moving towards sell-side liquidity. When we combine a liquidity grab with an inversion fair value gap, the setup becomes even more powerful. Now, let's transition into ranging markets. While trending markets are often preferred, the reality is that markets spend more time moving sideways. If you focus only on trends, you will miss many valid opportunities, which is why learning how to trade a range-bound market is essential for consistency. A sideways or ranging market occurs when price stops forming higher highs and higher lows, or lower highs and lower lows. Instead, price moves between a clearly defined high and low, creating a horizontal structure. In this environment, the market is no longer trending and is moving between support and resistance levels, which requires a different trading approach. Before trading a range, we first need to identify it correctly. A simple method is to look for at least 2 rejections from the bottom and 2 from the top, showing that price respects both support and resistance. Once these levels are clearly established, we can consider the market to be ranging, while remembering that more touches strengthen the level but do not guarantee it will hold. In addition, the cleaner the levels, the better the setup. When support and resistance are easy to identify and price reacts clearly at those zones, the range becomes more reliable and easier to trade with confidence. Now we move into the first ranging market strategy, known as the third touch. The third touch of a level is often the most significant because it signals a higher probability reaction. When price approaches a level for the third time, we look for confirmation that the level will hold. If price is at support, we look for rejection to the upside, but we do not enter immediately. Instead, we wait for confirmation, such as a rejection wick or a strong move away from the level. Once that reaction is visible, we can enter the trade with more confidence. It is also possible to trade later touches of the level, but ideally with reduced risk to account for weakening structure. The second strategy is the break and retest within a range. When price breaks above resistance, that level can turn into support. We then wait for price to return and retest the level, and if it holds with clear rejection, we look for buying opportunities. On the bearish side, when price breaks below support, that level becomes resistance. We wait for a retest, and if the level holds with rejection, we look for selling opportunities, maintaining a structured approach in both directions. Sometimes, price breaks above resistance but fails to continue higher. This is known as a failed breakout. Instead of holding above the level, price quickly drops back into the range, showing that the breakout lacked strength and buyers could not maintain control. This situation often causes breakout traders to get trapped and take losses. To handle this, we introduce the next setup, the inside bar. The inside bar is a candlestick pattern where one candle forms completely within the range of the previous candle, known as the mother candle, indicating consolidation and indecision. In an uptrend, this pattern suggests that buyers are pausing and not pushing price higher. In a downtrend, it shows that sellers are losing momentum and the market is slowing down. This pause typically occurs before the next significant move. We trade inside bars as continuation setups. First, we identify a strong trend, then wait for the inside bar to form. After the pattern is confirmed, we enter on the breakout of the inside bar, aligning with the direction of the trend. In an uptrend, we look for a buy after a breakout to the upside. In a downtrend, we look for a sell after a breakout to the downside, with the target set at the next key level in the market. The best inside bar setups often occur within a ranging environment. To reduce the risk of false breakouts, we wait for price to first break above resistance, indicating a possible continuation. Then we wait for an inside bar to form, confirming a pause before the next move. Once price breaks above the inside bar, we enter a buy position, as this signals that buyers are stepping in again after the pause. Our stop loss is placed below the mother candle, and the target is the next key level, allowing for a structured and controlled trade. This approach helps us avoid false breakouts and only participate when the market confirms direction. Now, let's move into choppy markets. A choppy market is characterized by messy and unpredictable price movement, where price moves up and down without a clear trend or structure. In these conditions, the market generates many false signals, making it difficult to trade effectively. The best approach is to remain patient and avoid overtrading, waiting instead for the market to transition into a clearer trend or a well-defined range. Choppy markets are particularly dangerous because they can quickly lead to unnecessary losses. The key is to recognize this environment early and protect your capital by staying out until better conditions appear. Finally, it is important to understand that waiting for high-quality setups and filtering out low-quality ones is a skill that must be developed over time, especially when applying a liquidity trading strategy with discipline. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.